Life insurance is one of the most important yet most misunderstood financial product. At one end, many people don't even have the insurance. And those who have life insurance, either the product is not right or the cover is simply not enough. And the worst part is, most people don't even realize it. Honestly, I don't completely blame people for this. Because if you look at how most insurance products are designed, they are not very easy to understand. On top of that, the majority of insurance agents are driven by commission. They try to push insurance products where they get higher commission. So what happens is, people end up taking a life insurance policy based on someone's suggestion, a friend, a colleague, maybe an agent, without really understanding what they are buying. And then they just forget about it. The problem only comes much later, when the actual need arises. Now, if you think about it, this is probably one of the few financial decisions where a small mistake can have a very large impact. So instead of complicating things, let's try to simplify this entire topic. What exactly is life insurance? What term insurance means? How is it different from traditional policies? And most important, how much cover you actually need and how to choose the right plan. So if you are someone who is planning to take life insurance or someone who has recently taken life insurance, this video could be extremely important. Alright, let's get started. Now, typically when people think of life insurance, they mix two things, protection and investment. These policies promise that if something happens, the family gets a payout. And if nothing happens, you get a maturity amount. There are many such plans like endowment, money back, whole life, ULIPs. But the common issue is they are expensive and insurance cover is quite low. For example, someone paying 50,000 annually might just get 10 lakh rupees cover, and after 25 years, the maturity value may be only around 5 to 6% return. So while the idea of combining insurance and investment sounds good, in reality, both gets compromised. The cover is inadequate and returns are not very attractive. Plus, there are lock-ins. That's why it's important to understand what you are buying, and this is where term insurance comes into picture. Let's understand it. So within term plan, the word term simply refers to a specific time period. If something happens to a person within that time period, the family gets financial protection. But if the person survives the policy term, there is no maturity benefit. For example, let's say a 30-year-old working professional takes a term insurance of 1 crore for 30 years. Now, two things can happen. If the person passes away during the policy period, the family receives 1 crore rupee, which can take care of expense like education, loan, and day-to-day needs. And if the person survives the policy period, there is no payout. Now, term plan might not sound great because you don't get anything on maturity. But the biggest differentiation is term plan cover protects your family at a very low cost. For instance, a person in their 20s can get a term plan cover of 1 crore rupee for as low as 800 to 1000 rupees per month. So instead of mixing insurance and investment, the better approach is to keep them separate. Take a term plan for low cost and invest the remaining amount in, let's say, mutual fund, PPF, or any other instrument. Now, if you want to know the right term plan for your family, I would strongly recommend exploring Ditto Insurance. They are an advisory platform backed by Zerodha. The best part about Ditto Insurance platform is, unlike other platforms, Ditto never spams you with calls or message. They would not force you to buy the policy. There is no mis-selling at Ditto Insurance. In fact, they have no sales pressure policy in their company. What they do is, if you book a 30-minute free phone call, the insurance expert will discuss everything with you and suggest a suitable policy and company for you based upon your needs and requirement. Another important thing, if you already have a policy and if you have any doubt about it, they will also give you good guidance about the policy. And the best part is, they help you with claim settlement as well for your policy for 24/7. So you can book a free 30-minute consultation call with Ditto Advisor to get the best advice. Link I provided in the description and pinned comment. Now, next step is to look at the different type of term plans available. So first is level term plan. This is the simplest one. You pay the same premium every year throughout the policy term. If you take a term plan, let's say for 30 years at the age of 30 and pay a premium of rupees 12,000, you will have to pay the same 12,000 rupees premium till you turn 60. In the meantime, even if your health deteriorates, the premium you have to pay will not change. Then second is increasing term plan. If someone has taken a term plan, let's say 10 years ago, even rupees 50 lakh was enough. Today, people think 1 crore is enough. So what is happening is, due to inflation, our lifestyle expenses are increasing. And that's where today's 1 crore might not be enough 10 years later. Hence, you have an increasing term plan option where your sum assured will automatically increase every year. This increase will be adjusted to keep pace with inflation and increase in your liabilities. Of course, the premium is slightly higher than term plan mentioned earlier, but wouldn't it be great to have an option of increasing term plan cover with inflation so that you don't have to worry about rising cost? Unfortunately, many people are not even aware of such option. Likewise, there are a lot of clauses and terms and conditions that normal people struggle to understand. Hence, you should take guidance from the right insurance advisor before taking a term plan. Then third is decreasing term plan. So this works in the opposite way. The sum assured reduces over time. These are usually linked to loans like home loan, car loan. So as your outstanding loan reduces, the insurance cover also reduces. Such term plans are taken only for loans. It is not useful for family protection. And in general, it is not recommended because you have to accurately predict when your liabilities will end, which is quite difficult. Then fourth is return of premium plan. In this plan, if you survive till the end of term, the premiums paid are returned to you. But the catch is, the premiums are 70-80% higher as compared to regular plan, and the returns are quite low, even lower than fixed deposit in many cases. So from an investment perspective, it does not really make much sense. Then fifth is zero cost or exit option plan. Here you have the option to exit the policy at certain stage. Let's say at age of 60-65 and get your premium back. The idea is that once you realize that you have enough capital for your family's protection and your family settled, you don't necessarily need to continue with the term plan, because after maturity of term plan, you anyways won't get anything. So the zero cost or exit option gives you the flexibility to either continue with the plan or exit the policy at certain age. So out of all these options, personally, I prefer keeping it simple. A standard level term plan is usually good enough, along with a few relevant riders, which we will discuss later. Now, before we move ahead, one very important question comes up here. How much term insurance cover is actually enough? Because this is where most people either underinsure themselves or just take a random number like 50 lakh, 1 crore because it sounds right. But ideally, your insurance cover should not be a random number. It should be based on your financial reality. So let's discuss it. Now think about this simply. If you are the primary earning member of your family, your income is what runs the entire household. Monthly expense, EMI, children education, long-term goals, everything depends on that income. So in case something happens, the idea of term insurance is to replace that income. A very basic thumb rule that many advisors suggest is your coverage that is required should be equal to annual expense multiplied by 20 plus your outstanding loan minus your existing asset. For instance, if you visit Ditto platform, there's a term insurance calculator where you need to enter certain data like your age, protection duration, monthly expense, outstanding loan, and this tool will recommend you the term plan cover that you should take. So let's say your age is 30 years. Let's say you want to take insurance till 60 years of age, and let's say you have a monthly expense of 50,000 rupees, and assume you have a loan of 20 lakh rupee. And if you just click on calculate, there you go. So this is recommending you a cover of 2.3 crore rupees. Here the explanation has been provided. So today your expenses are 50,000 rupees a month, but by 2056, your 30 years down the line, your expenses will be 2.27 lakh a month, considering an inflation of 5%, right? So this is how you can get an idea in terms of how much cover you would need. Please note that this calculation does not take into account inflation, future education of children, where the corpus can be invested. For that, you can contact Ditto advisor for better understanding or use the calculator on their website. Also, if you've taken a term plan already, let me know in the comment how much cover you have taken. Now, once you have a rough idea of the coverage, a lot of people have a doubt on whether you should take a term plan online or offline. So the first thing to understand is that insurance product itself does not change. Whether you buy it online or through an agent, the policy is issued by the same insurance company and even the claim process is handled by the same company. The difference actually comes in areas like cost, convenience, and guidance. If you look at cost, the online plans are generally cheaper. The reason is simple. There is no intermediary involved. So the insurance company does not have to pay commission. Because of that, the premium you pay is usually lower for the same coverage. Over a long period of 20-30 years, even a small difference in premium can add up to a meaningful amount. Then comes convenience. When you buy a plan online, everything is in your control. You can compare multiple policies, go through the feature at your own pace, and complete the entire process without depending on anyone. In the offline mode, you are usually shown a limited set of options, generally from the companies that the agent is associated with. I've personally seen many cases where the options given by agent are limited to the company they are associated with. So your comparison may not be that wide. Now, if you're someone who is not comfortable understanding policy document, or you feel confused with too many options, an agent can help simplify things and guide you through the process. But the catch is, since agents earn commission, they can be biased towards certain product. That does not mean all agents are mis-selling, but it's something you should be aware of and keep in mind while making a decision. So if we simplify this entire discussion, if you are comfortable doing a bit of research and understanding what you are buying, going online usually make more sense because of lower cost and better transparency. And for guidance, you can always take help from Ditto team by booking a free 30-minute session. Their advisors are IRDAI certified, so you'll get genuine advice. Now the next question is, how do you select the right term plan? Today there are so many companies, so many plans, and on the surface everything looks similar. But there are a few key factors that you should always keep in mind. First is claim settlement ratio. This basically tells you, out of all the claim received by the insurance company, how many were actually settled. For example, if a company has a claim settlement ratio of 98%, it means out of 100 claims, 98 were settled. The higher this claim settlement ratio, the better it is. Second is amount settlement ratio. A mistake many people make when looking at an insurance company's claim settlement is not looking at how much money the company actually paid out. That's called ASR, amount settlement ratio. ASR is a ratio that tells the company what percentage of the total claim is actually paid. Some companies may approve smaller claims in the range of 25 lakh to 1 crore, and larger claim like 4-5 crore rupee may be delayed or rejected. This may show higher claim settlement ratio, but amount settlement ratio would be lower. For example, there is company X, which 99% claims settled, but major claims are unpaid. Whereas company Y has settled 98% of claim, but paid all claims in full. In this case, company Y is better than company X. Then third is complaint ratio. It shows how many complaint an insurance company receive for every 10,000 claim. Some companies process the claim, but may burden your family with unnecessary document, delay, and not provide proper support. So make sure that company has a lower complaint ratio. Fourth factor is solvency ratio. It indicates whether the insurance company has enough money to pay claims in case of disaster. For example, company should have the ability to settle claim without any difficulty in case of a natural calamity or situation like COVID. As per IRDAI norms, a minimum solvency ratio of 1.5 is mandatory. More than 2 is better. Then fifth factor is company's credibility and track record. Since you are buying a policy that may last 20-30 years, so you want to go with a company that has a strong presence, good reputation, and long-term stability. Because at the end of the day, this is a promise-based product. So overall, a good insurance company should have claim settlement ratio of more than 95% in last 3 years as an average. Amount settlement ratio should be more than 90%, which is average of last 3 years. Complaint ratio should be less than 20 for every 10,000 claim. Solvency ratio should be more than 2, and a good track record of 10 plus years. In case you need help with identifying companies that fit on these parameters, you can book a free call and take help with Ditto Advisor. Next, while opting for a term plan, you will come across many add-on features called riders. So what are the riders, and should you choose any rider? Let's discuss it. So there are 5 riders that you should be aware of. First is critical illness rider. In case of life-threatening disease like heart attack, cancer, kidney failure, organ transplant, if you have this rider, insurance company will pay the amount of the cover. Second is accidental death benefit. In this case, when the person dies, family gets the accidental coverage along with the insurance cover. For example, if a person has taken 50 lakh term cover and 20 lakh accidental death rider, in case of death from accident, family would get 70 lakh cover. Then third is waiver of premium rider. If the person taking the term insurance becomes seriously ill, or the person is unable to do any work due to an accident, then with this rider, the company will bear all the premium in the future. person insurance policy will continue. Then fourth is terminal illness benefit rider. If the insurance policy holder is diagnosed as terminally ill and has only a few months to live, with this rider, the insurance company will pay the claim amount of the policy in advance instead of waiting for the person to die. And fifth is life stage increment rider. By taking this rider, you can automatically increase your term cover at important stage in your life. For example, when you get married, when your first child is born, when your second child is born. So once you know about all these riders, the final thing you need to do is take a term insurance policy along with one or two of these important riders that suits your need. Some important riders I suggest are critical illness, waiver of premium, and terminal illness. The next question is, at what age should you take a term plan? And simple answer is as early as possible. Because your premium is directly linked to your age and health condition. The younger and healthier you are, the lower your premium will be. And that premium gets locked in for the entire duration. For example, a 25-year-old and a 35-year-old taking the same 1 crore cover, the younger person might end up paying significantly lower premium for the same benefit. Also, as you grow older, the chances of medical condition increase, which can even increase your premium or even lead to rejection in some cases. Hence, delaying this decision does not really help. Now, while opting for a term plan, you will come across multiple payment options for your term plan premium. You have regular payment, limited payment, and single pay. A lot of people get confused in terms of selecting the right payment option. Let's discuss it. So there are mainly three options: regular pay, limited pay, and single pay. Regular pay is the most straightforward option. Here you pay the premium every year throughout the policy term. So if your policy is, let's say, 30 years, you will keep paying the premium for all 30 years. The advantage here is that the yearly premium is the lowest compared to other options. So it does not put a heavy burden on your cash flow. This is why most people prefer this option. The only thing to be mindful is consistency. You need to ensure that premiums are paid on time every year. Then comes limited pay. In this option, your policy term may be 30 years, but you choose to pay the premium only for a shorter duration. Say 3 years, 5 years, or 10 years. After that, you don't have to pay anything, but your coverage continues for the full term. Now, obviously, since you are paying for a shorter time frame, the premium per year is higher than regular pay. But the benefit is that you finish your payment obligation earlier, which can be useful if you expect your income to peak in the early year or if you want to be free from fixed commitment later in the life. And the third option is single pay. As the name suggests, you pay the entire premium upfront in one go and your policy remains active for the entire term. There is no future payment obligation at all. This is usually chosen by people who have surplus capital and prefer a one-time commitment instead of managing yearly payment. But from a practical standpoint, this option is less popular because it blocks a large amount of money upfront, which could otherwise be invested elsewhere. So which is the better option? If you simplify this, for most people, regular pay works perfectly fine. It keeps the premium manageable and aligns well with your income flow. Also in future, if you achieve your financial goals and you do not need a term plan anymore, you can choose to discontinue it. Limited pay can make sense only if you have strong income visibility in the initial year and want to reduce long-term commitment. Single pay is more of a niche option and only makes sense if you have excess liquidity and very specific reason to avoid future payment. So again, like most things in finance, there is no one-size-fits-all answer. It depends on your cash flow, financial discipline, and personal comfort. But if you don't want to overthink it, sticking to a simple regular pay option is usually good enough. Now I know that it can get a bit confusing to digest all this information, but life insurance is an extremely important part of our financial planning. Within this, term plan is the best category. I've tried to discuss majority of questions around selecting the right term plan. However, if you still have any doubt, you can book a 30-minute slot with Ditto Advisor and they can guide you in selecting the right term plan as per your requirement. And if you know someone who has not taken a term plan or someone who has taken a wrong life insurance, do share this video with the person. I'll see you in the next video. Till then, take care.